Hi friends, my name is Nilesh Fadke and I help people to understand finance and accounts. In this video, we will learn about the meaning of the fund flow statement and how fund flow statement is prepared. So here we go. Fund flow statement. A fund flow statement is a financial report that explains the changes in company's financial position by identifying the sources and uses of the funds between two balance sheet dates. Here items of balance sheet are split into sources of funds and application of the funds. Let us first understand how balance sheet always tallies. So let us see first scenario where liability increases. So you have given a balance sheet of year 1 and year 2. In year 1 share capital is 1000 and cash and bank balance is also 1000. So total liabilities is 1000 and total assets is also 1000. In year 2, share capital increases from 1000 to 2000, and hence to tally the balance sheet, we have to increase cash and bank balance also from 1000 to 2000 so that our balance sheet tallies. That is, total liability of year 2 is 2000 and total assets of year 2 is also 2000. Now, there is an increase in the liability from 1000 to 2000, and hence we need to increase the cash and bank balance from 1000 to 2000. So increase in cash and bank balance means sources of the funds, and this has happened due to increase in the share capital, that is increase in the liability. Therefore, increase in liability results in increase in cash, also called as the funds, to tally the balance sheet, and hence increase in liability is always sources of the funds. Now let us consider second example where liability decreases. So year 1 share capital is 1000 and year 2 share capital is 200. So it decreases by 800, and hence to tally the balance sheet we have to decrease asset side also. So cash and bank balance in year 1 is 1000, which decreased to 200, that is by 800, to tally the balance sheet. So your liability side decreases by 800 and also your asset side decreases by 800, and thus your balance sheet tallies. Now, when liability side decreases, you have to decrease the cash and bank balance to tally the balance sheet, and hence decrease in liability is always application of the funds as cash and bank balance reduces. So decrease in liability results in decrease in cash, also called as the funds in the fund flow statement, to tally the balance sheet. Now let us consider the impact on asset side. So example where asset increases. So on balance sheet year 1 share capital is 3000 and year 2 is 3000. Fixed asset in year 1 is 2000, cash and bank balance is 1000 and total assets is 3000. So total liability on year 1 is 3000 and total assets is also 3000 on year 1, and our balance sheet tallies. In year 2 liability remains the same, that's why in year 2 share capital is also 3000. However, fixed asset increases by 200, that is to 2200, and hence to tally the balance sheet we have to decrease cash and bank balance by 200, so it will become 800. So on year 2 total liabilities is 3000 and total asset is also 3000. So here fixed asset increases, and to tally the balance sheet we have to decrease other asset, that is cash and bank balance. So increase in asset other than cash results in the decrease in cash, also called as a funds here in fund flow statement, to tally the balance sheet, and hence increase in asset is always application of the fund as cash and bank balance reduces. Now let us consider fourth scenario where example where asset decreases. So on balance sheet liability side year 1 3000 and year 2 is also 3000 as liability remains the same. Year 1 fixed asset is 2000, cash and bank balance 1000 and total assets is 3000. So our balance sheet of year 1 tallies by 3000. In year 2 fixed asset decreases by 200, that is it becomes 1800, and to tally the balance sheet we have to increase cash and bank balance by 200, and hence it becomes 1200. So one asset decreases, and to tally the balance sheet we have to increase other asset by 200, that is cash and bank balance. Decrease in asset other than cash results in increase in cash, also called as a funds in the fund flow statement, to tally the balance sheet. Prepare fund flow statement if 2 years balance sheet is as follows. So balance sheet of year 1 is given and year 2 is also given. So share capital 1000, retain earnings 608, loan 100, salary payable 50, trade payable 60, other liabilities 70. So total liabilities is 1888. On asset side, fixed asset 800, investment 100, inventory 20, trade receivable 80, cash and bank balance 888, and total asset is 1888. In year 2, share capital is 1000, retained earning is 1281.60, loan 110, salary payable 60, trade payable 65, other liabilities 50. So total liabilities is 2566.60. On asset side, fixed asset is 720, investment is 235, inventory is 40, trade receivable is 100, cash and bank balance is 1471.60, and total assets is 2566.60. And we have to prepare fund flow statement. So let us prepare a table where you will write year 1 balance sheet here and year 2 balance sheet here, and you will take a difference between two balance sheet dates, that is B minus A. So share capital of year 1 is 1000, year 2 is also 1000. So there is no change between 2 years. As no change, hence no sources or application of fund, and fund flow amount is dash. So presentation in fund flow statement is dash. Now retail earning of year 1 is 608 and year 2 is 1281.60. So change, that is B minus A, is 673.60. There is an increase in retail earnings from 608 to 1281.60. That means there is an increase in liability. And hence increase in liability results in increase in the cash or funds to tally the balance sheet, and hence sources of the fund. So 673.60 as sources of the funds. It will be presented in the fund flow statement as the sources of funds. Loan 100 become 110, so 10 is a change, and it increase in liability results in increase in cash or funds to tally the balance sheet, and hence sources of funds. So fund flow amount is 10 and presentation in fund flow statement is 10 as sources of funds. Salary payable increases from 50 to 60, so it becomes 10. So increase in liability results in increase in cash or funds to tally the balance sheet, and hence sources of funds. So fund flow amount is 10 and 10 is written in fund flow statement as sources of funds. Trade payable 60 becomes 65. So increase is 5. So increase in liability results in increase in cash or funds to tally the balance sheet, and hence sources of the funds. So fund flow amount is 5. 5 is the sources of funds. Other liabilities 70 becomes 50, so minus 20. So decrease in liability results in decrease in cash or funds to tally the balance sheet, and hence application of funds. So fund flow amount is minus 20 and 20 is written as application of the funds. Thus we have finished liability side. Now let us go to asset side. Fixed asset 800 becomes 720, so minus 80 is the change. So decrease in assets results in increase in cash or funds to tally the balance sheet, and hence sources of the fund. So fund flow amount is 80. Even though it is written as minus 80 here, fund flow amount is 80 and 80 as a sources of funds. Investments become 235 from 100. So increase in asset is 135. So increase in investment result in decrease in cash or funds to tally the balance sheet, and hence application of funds. So minus 135 is a fund flow amount. So 135 as application of funds. Inventory 20 becomes 40. So it increases by 20. So increase in inventory results in decrease in cash or funds to tally the balance sheet, and hence application of the funds. So minus 20. So 20 as application of the funds. Trade receivable 80 becomes 100. So 20. So increase in trade receivable results in decrease in cash or funds to tally the balance sheet, and hence application of the funds. So fund flow amount minus 20. So 20 as application of funds. Cash and bank balance 888 becomes 1471.60. So 583.60. Increase in cash and bank balance results in decrease in cash or funds to tally the balance sheet and hence application of funds. So minus 583.60. So 583.60 as application of the funds. Now in this case, cash and bank balance is considered separately as an asset, and hence increase in cash and bank balance results in decrease in cash or funds to tally the balance sheet. Here cash and bank balance asset is considered similar to trade receivable and inventory. Thus, first we prepare a table where we derive the amount of fund flow statement, and we derived how to present the same in the fund flow statement. Now let us actual prepare fund flow statement. So all sources of funds will be written at one place and all application of funds will be written at one place. So increase in return earnings 673.60, you can see here as a sources of funds. 10 as a sources of fund is increase in loans. Then salary payable increase 10 as a sources of funds. So you have written here loan taken 10, increase in salary payable 10, increase in fixed asset, increase in trade payable is 5. You can see here increase in trade payable, increase in trade payable from 60 to 65. So 5 is the sources of funds. And decrease in fixed asset is 80. So here sources of the funds 80. Why? How 80 comes? That is basically decrease in fixed asset. So all sources are written at one place. So total sources of fund is 778.60. Similarly, let us write all application of funds at one place. So decrease in other liabilities 20, increase in investment 135, increase in inventory 20, increase in trade receivable 20, increase in cash and bank balance 583.60. All application of fund, that is 20, 135, 20, 20, 583.60, we have written here under the application of funds. So total sources of funds is 778.60 and total application of funds is 778.60 and our balance sheet tallies. Thus to conclude, what we can say is that as a first step to prepare a fund flow statement is to compare balance sheet between two periods, that is year 1 and year 2. If there is an increase in the liability between year 1 and year 2, then to tally the balance sheet, we have to increase the asset side. And hence, increase in liability is always treated as a sources of the funds. Similarly, if there is a decrease in the liability between two balance sheet dates, then to tally the balance sheet, we have to decrease the assets. And hence, decrease in the liability side is always treated as an application of the funds. Similarly, on the balance sheet asset side, if there is an increase in the asset, then to tally the balance sheet, we have to decrease the other asset. And hence, increase in the asset between two balance sheet dates is always treated as an application of the funds. Similarly, if there is a decrease in assets between the two balance sheet dates, then to tally the balance sheet, we have to increase the other assets. And hence, decrease in the asset is always treated as a sources of the funds in the fund flow statement.